Shale oil production is becoming a popular topic in the energy space as the U.S. increases production of this new source of oil. Reports that China may be looking to invest heavily in shale has sent panic waves to countries heavily dependent on crude oil exports, particularly African countries like Nigeria and Angola. Now, Africa's major oil exporters face the prospects of not just losing major customers like the U.S. and China, but also losing other markets to the world's two largest oil consumers. For more on what to expect in the oil and gas space going forward, I'm now being joined by John Kingston, his Global Director of News at Platts. Thank you, John, for your time.
Thank you for having us.
Well, thank you, John, for joining us on the program. Now, in the last 2 weeks or so, top Nigerian government officials have expressed concerns about the possibility of losing market share to the U.S. and perhaps China if this shale oil production continues. Now, do you think this is a legitimate concern for African governments?
Well, it's not just a concern, it's a reality. The fact is, if you look at the data, Nigerian and Angolan imports of oil into the U.S. have dropped considerably. I don't know the numbers off the top of my head, but this is not just something that's out there that might happen. This is very much happening. The shale plays, for the most part, the ones down in Texas and the Eagle Ford, the ones up in North Dakota and the Bakken, what they produce is a very light crude, and it's going to displace probably other light crudes. And in that case, you're talking about Angolan crudes and you're talking about Nigerian crudes, the main two. So the data shows that that imports from those two countries are down. So this is not just a possibility. This is very much a reality. And in fact, you know, to kind of show the problem, not the problem, it's not a problem from the U.S. side, but it's certainly a problem from an exporter side. North Dakota came out with its June numbers yesterday, or maybe May numbers, and it was up 2% in 1 month, their output. That's not insignificant. That's a lot at this point. So, you know, all that oil is displacing some imports, and in particular, it's going to hit the light imports, the light crude imports from places like Nigeria and Angola.
Now, in response to this rise in shale oil production at its last meeting in Vienna, OPEC, on May the 31st, the oil minister of Saudi Arabia did say that yes, it's a major concern for OPEC, and that if it gets out of hand, OPEC could simply curb output into the market to help sustain prices at, of course, above $100 where the oil cartel wants it to be. But of course, that could also be a problem for African countries such as Nigeria and Angola. These economies depend heavily on revenues that they get from oil sales. So do you think this, perhaps some internal rift within OPEC, this could hinder the cartel's decision or its ability to come up with a plan to help curb perhaps deepen its profit, or rather demand for its oil going forward?
Well, what OPEC has mostly done is that Saudi Arabia has pretty much shouldered the burden of putting more supply on the market and taking supply off the market as is needed. Well, we track the output of every OPEC nation every month, and when you look at the Saudi numbers, they're up, they're down, they're up, they're down. The numbers, you know, right now, of course, the price is pretty good from the producer side. It's well over $100 basis Brent. But when you look forward into 2014, the International Energy Agency next year says the call on OPEC crude, that is the amount of OPEC crude that's going to be needed, is going to decline, and it's going to decline even as world demand is rising. It has declined in the past, but it usually declines when demand is falling, like after the financial crisis in 2008 and 2009. So their projection for next year is really unique. Now, the Nigerians, quite frankly, in a roundabout way, have contributed to strengthening the price because of all the turmoil, the theft, the failure to pass the petroleum investment bill. Their production has declined sharply, and it's down now to about 1.7, 1.8 million barrels a day. Their budget for the year assumed a production level of 2.5. Their capacity has been estimated as high as 3.2 million barrels a day. So Nigeria, in a way it really didn't intend, is already supporting the price. I would say that if OPEC feels the need to cut back sometime in 2014, which is really when a crunch might come, the Nigerians are going to say, hey, look, our industry has had a lot of problems. Our output is already down quite a bit. You can't ask any more of us. I don't know whether that argument will go with OPEC, but I do think that the Saudis do seem prepared to shoulder most of this burden, and that might spare Nigeria or Angola from having to make any cuts.
Well, still on OPEC, the cartel actually set up a committee to look at the impact of oil prices, particularly going forward, how it could impact on international oil prices, and what perhaps give it a better view on what kind of decision to take to help protect the cartel.
Well, look, remember, OPEC was put together many years ago in order to manage glut. That is their job. Their job isn't necessarily to drive prices higher. Their job is to make sure that there is not a glut of oil in the market. They have been doing a fairly good job of that recently, but now this is their biggest test. Nobody, let's say 6 or 7 years ago, saw this rise in U.S. output coming. And what they've done in the past is when there is a glut, they all kind of take what's known as a haircut. They reduce their output. Now, that hasn't been happening because the Saudis have been taking on that role, but the Saudis are not going to want to take that on forever. But if you're Nigeria, you've already seen your output decline so significantly because of problems in your industry. Are you willing to take a further haircut? That's going to be a real problem. This is always when it gets very tough for OPEC, when they have to make cuts. Right now, the price is pretty strong, so they haven't had to do so. The one thing I would say that may allow everybody to avoid those decisions is that demand, particularly in the West, does seem to be coming back, at least out of the U.S., but Chinese demand is flat. So demand may come to the rescue a little bit. If the U.S. economy strengthens, they may not have to make those decisions. But if they do have to make those decisions, it's going to be very difficult because they're only going to be faced with that decision if the price falls. Right now, with, let's say, $106, $107 Brent, I guess maybe it's a little higher than that, that makes for a nice revenue stream for the Nigerians. But their output is so far down that they're not being able to reap the full benefit of that.
Okay, John, finally, before I let you go, your thoughts on what the oil market will look like given the present dynamics now 5-6 years down the line?
Five to 6 years down the line? Well, I think the real factor on that is going to be, you mentioned earlier, the Chinese trying to get into shale. The shale technology has been very much of a U.S. phenomenon. The Chinese have bought stakes in shale plays. Other countries have done so as well to learn the technology to bring home. One thing about shale plays, unlike let's say, a deep water oil play, when you drill into the shale, your success rate is close to 100%, and that oil comes on right away, and it comes on fast. So if you can export the U.S. shale revolution to other parts of the world, you're going to have a significant uptick in supply. Now, all projections are for also a significant increase in demand. One of the areas that's expected to have that big increase in demand is Africa, because it has some of the fastest growing economies of the world. But there's also a significant amount of gas production. Mozambique is going to be a gas giant over the next several years. The question is how much of that gas maybe displaces oil in some applications. So there's a lot going on. Right now we've got the potential for a lot of supply, and how we handle that is going to answer that question about where the market is 6 to 8 years down the road.